2022 has been a scary year for stock markets, but could there be further shocks in store for us? Yes, they could. So in this video, I look at 5 scary stories, but remember that with each of these scary stories comes a buying opportunity, and I'll cover those along the way. Now, don't forget, if you enjoy our content, please do subscribe to our channel. It's absolutely free. Now let's look at those 5 scary stories in a bit more detail. And let's begin with a zombie apocalypse. Now, people have been talking about a zombie apocalypse for some time in markets, and what they're referring to is not the shambling undead eating our brains, but instead it's companies which can't service their debt. And there's recently been a report by Swiss Re which looks at a fairly alarming increase in default rates amongst companies globally. Now, usually when an economy goes through a recession, you'd expect a pickup in the default rate. That's the number of companies which are going bust. And on average, year to year, you'd expect a default rate of around 5% for companies which have slightly dubious credit. These are called high yield issuers. So in this graph in the top right, you can see that default rate since 2003. The blue line here is a historical default rate, which of course picked up in 2009, but also during the pandemic. And what's interesting is the quite shocking forecasts, which are the estimates from Swiss Re. And it's got various scenarios. So Moody's, the rating agency, this is their baseline forecast, where default rates peak at 5%, but you can see that Swiss Re's moderate downside and severe downside forecasts blow well above that 5% rate. And in the severe scenario, it's not much less than a 15% default rate, which is similar to the global financial crisis. What's also interesting is they've decomposed the default rates according to whether a company's cyclical, in other words, tied to the economic cycle, that would be things like financials, or whether it's defensive, that would be a company like a pharmaceutical company or a utilities company. And what's really interesting is that cyclicals have a lower default rate. Presumably that's because they're used to the boom-bust cycle and they put aside cash for just such a crisis. And that's why they think that in defensives, the default rate could be higher. So how can we tell just by looking at a company's results whether it's going to be a zombie? Well, the measure that people usually look at is something called interest cover. So there you take the EBIT, the earnings before interest and tax, and then divide by the interest which they have to pay on their loans. So that would be bank loans, but also things like corporate bonds, which they've issued. Now, if the EBIT, the cash they've got left over to pay their interest expense, is very small, then we'll have a ratio which is less than 1. That's because the EBIT will be less than the debt servicing cost. And that is technically a zombie. Now, that doesn't mean instant death. There are various options open to the company, and if it has a large cash pile, it can just eat into that cash pile. Now, if it doesn't have enough cash reserves, what can it do? It could try to borrow more, but of course we're entering a new period when debt servicing costs are higher. There may not be much appetite for it to issue equity either, or it could sell some of its assets for cash, or the unpleasant one is that it could default. Now, why should stock investors care about this? Well, this is still a scary story for stock investors because you'll lose everything if your stock goes bust. That's because you're at the back of the queue when it comes to liquidation payouts. Corporate bond investors will be ahead of you in the queue. So just like Moody's, if you look at S&P's forecast, they're only expecting it to reach about 3.5%, and this is for the US. And even their pessimistic forecast, which you can see here at the top, is only 6%. So Swiss Re's forecast is way out there. So how could we monetize this as investors? Well, you can always buy a junk bond ETF like HYG or JNK, but in order to make that worthwhile, markets have to compensate you enough for the credit risk. So if you want a measure of the compensation you receive right now, that would be credit spread. So for example, for European high yield corporate bonds, currently you get paid about 5.9%, and that's above the risk-free rate for taking the credit risk of dodgy companies in Europe. Whereas in the US, you're only being paid about 4.5%. So by monitoring these credit spreads, which are freely available, you can say, okay, I think this compensates me enough for the risk that I see of defaults over the next year or so. In the EU, I'd be looking at that and thinking, yeah, that looks pretty good. In the US, I'd think it's probably too low. But that's why junk bond ETFs are part of my market crash shopping list. I'm watching these spreads very carefully for a point at which I think is very attractive. So what should we expect if the US enters a recession? Well, as this comment from Mark Zandi says, a credit spread consistent with a US recession would be about 7%. And as we saw, the US is well below that right now. So effectively, the high yield market in the US is currently telling you, no, there's not going to be a recession. Whereas if we look at European high yield spread, yeah, it certainly looks like a possibility. But even if you're a single stock investor, you probably want to monitor that interest cover measure and also look at how much free cash the company's got if its interest cover is less than 1. Because remember, it can always eat into its cash pile in order to survive. Our second scary story is a US earnings recession. Now, normally when we talk about recession, we talk about GDP growth, but an earnings recession is even worse for equity investors. That's because it produces a really strong drag on prices. Now, the Q3 results we've seen so far look pretty good for the S&P as a whole. We're looking at roughly 2.2% year-on-year growth. But if we strip out the energy companies, suddenly that growth turns into a fall year-on-year of minus 5.1%. Similarly, the full year results, if we extrapolate for 2022, look awful if we strip out energy. Instead of a 6.1% year-on-year growth, we get a fall of minus 0.6 for the whole year. Now, if we break it down quarter by quarter, the last time when energy didn't make that much difference was Q1 of 2021. But almost for every quarter since then, if you strip out energy, you actually get a smaller year-on-year increase. And if we jump forward to Q2 of 2022, that's when, if you strip out energy, you actually get a year-on-year fall. So stripping out energy hurts until we get to Q2 of 2023. So based on broker forecasts for earnings, the big boom we're getting in energy stocks is going to end pretty much when we get to that Q2 point next year. So while energy has certainly been a way of avoiding the sell-off in stocks this year in the US, that may not be the case going into 2023. So why do we care about earnings recessions anyway? Well, if you look at recovery time for US markets when they sell off, the deeper the earnings recession, the longer it takes markets to recover. So if we look at the earnings fall in peak to trough terms here, that's on the x-axis, with the biggest falls here on the far left-hand side, and we plot that against the recovery time in years, you can see that the recovery time is greatest when there's the greatest earnings recession. So for example, the period from 2000 to 2013 was the longest recovery time ever for the S&P, and that came with a catastrophic earnings recession, mostly during the global financial crisis. But there was a similar event in 1916 to 1924. Then we had the Great Depression, and that was 1929 to 1936. And of course, we had the Second World War, which also caused a 50% earnings recession, and it took the S&P a long time to recover. The 1973 to 1985 episode is interesting because although there wasn't a huge earnings recession, it was actually inflation which caused the recovery time to increase. That's because you're battling against inflation, because here I'm looking at real total return above the rate of inflation. So this time around, that's also going to be a headwind with inflation above 10%. So the recovery time is longer, the deeper the earnings recession. It also turns out that the peak to trough fall for the S&P is bigger if it's a bigger earnings recession. So again, we've got the earnings fall, peak to trough along the bottom, but now we've got the fall in the S&P 500, the drawdown from the previous all-time high. And you can see that generally, the bigger the peak to trough fall in earnings, the greater the fall in the S&P 500. So earnings recessions are very, very scary because they make these falls in the stock market both deeper and longer in duration. How can we monetize this? Well, you can certainly buy if equities are cheap. So this could create better entry points further along the road if we do get a full-on earnings recession. And certainly energy companies have been one way to dodge the bullet because earnings have been good for energy companies relative to other sectors because of high energy prices. However, as we saw, you have to be careful because next year, that big boom in energy prices is probably going to wear off. And markets are forward-looking, so they'll probably react before that actually happens in the numbers. Now, I hope I haven't scared you too much so you won't pay attention to this message about PensionCraft. It's a really friendly community where you can learn more about investing. You get access to Slack, so you can ask me a question whenever you like, or from other members of the community, and you get access to lots of members-only video content. So to learn more about that, just click on the link beside me and in the description beneath me. Our third scary story is about mortgage costs. So if we look at the cost of funding a median priced house in the United States, and this is the monthly cost of the mortgage, and that's also based on the 30-year fixed mortgage rate in the US. Now, house prices haven't really come down at all in the United States so far, at least not the median value, whereas if you look at funding costs for mortgages, that mortgage rate has increased massively. So the combined effect is that instead of paying around $1,500 a month, you'll be now paying twice as much, and that's occurred very rapidly. Now, the direct impact of that is obviously going to be on house prices. I expect those will slow down further, but there's also a secondary effect on loans which are made by companies such as banks to people who have these mortgages. There's no pickup in delinquency rates yet, but that will probably happen if rates stay high. And simultaneously, if prices come down, that could also be a problem, because then you have something called the wealth effect, because if people don't feel so wealthy, they tend to spend less, and that means less revenue for US companies. In the UK, the latest Bank of England data shows that there's a similar cooling effect, which is likely to happen because of the very rapid increase in mortgage costs. We don't have 30-year fixed rates in the UK, instead we usually fix for 2 to 5 years, and this is based on 2-year fixes in the UK with varying loan to value. So if you're only borrowing 75% of the value of the house, you can see the loan to value is now 4.2%. And that huge increase has happened since September last year, when you could have locked in a 1.2% rate compared to the 4.2% which you see currently. So again, I think banks are going to have to put aside more money for bad loans, and I think that there's also going to be a cooling effect on the housing market in the UK, but also elsewhere, such as Canada and Australia, where price to income ratios have also risen to record levels as they have in the UK. Now, there's no need to panic yet, because if you look at UK house prices, that's the blue line you can see here, that's the nationwide house price index. It hasn't actually even started falling yet. It's still rising almost at double-digit rates, even now in September of 2022. However, I think most people now agree that that's going to have to go into reverse. With a huge cost of living crisis combined with very rapidly increasing mortgage rates, that's going to be a huge problem for the housing market going forward. If we look at the US, this is broken down by region. There has been some sign of weakening markets. So for example, if you look at Los Angeles, it has come off the peak, but in other regions, prices continue to increase. So the pink line here is the Washington, D.C. metro area. Now, people often complain in my video comments where they say, look, I'm a first-time buyer, I've been locked out of the housing market, so I want there to be a crash. Well, this could be your opportunity. I think if there's ever been a recipe for a house price crash, or at least a huge softening of prices, this is it. Our fourth scary story is a strong dollar. And if we look at how much the dollar strengthened versus various currencies around the world this year, it's not just strength, it's utterly crushed some other currencies, such as the Turkish lira, the Japanese yen, Swedish krona, the Korean won, and of course the British pound. Why is this a problem? Well, if you look at this tweet from Claudia Sam, who's not scared to say what she thinks, she says it's inexcusable, bordering on dangerous, for the Fed to raise rates so aggressively. And she's talking about 4 percentage points on core inflation. That's what the Fed's trying to get rid of. Is that worth destabilizing Europe and pushing us into a global recession? No, it's not. Her point is a very valid one. While a strong dollar reduces import costs for US citizens, and that reduces inflation, it's disinflationary, that inflation goes elsewhere. It goes to all of the other counterparties which are paying more for their dollar imports. And of course, because energy is priced in dollars, it's been very damaging to the terms of trade for many countries around the world. So effectively what the US is doing is destabilizing other economies around the world and increasing inflation in other countries. Now, usually what happens when the dollar strengthens a lot is that we get an emerging market debt crisis. And if we look at distressed debt in emerging markets right now, and this is broken down as a block diagram where the area of the block tells you the size of the debt outstanding for that country. And distressed debt means that the sovereign debt's trading at yields more than 10 percentage points above that of similar maturity US Treasuries. So that would include Argentina, Ecuador, El Salvador, Egypt, and various other frontier countries around the world. But I think what's surprising about this graph is that it's not many EM countries which are affected. A lot of the Asian countries, for example, which were affected in 1997 in the Asian crisis, are not on this list. What's different about this crisis is that it's created problems for a lot of developed economies. How can we monetize that? Well, I think things like currency hedges, if you're a UK investor, I did a whole video about that, might make sense at this point because sterling is very undervalued relative to the US dollar. So if it does snap back to its fair value, that'll knock off a lot of return for UK investors. So this is why currency hedges for non-US investors might make sense at this time. And our final scary story is about the price of sweets, or candy as it's called in the US, and everything else. Now the US CPI basket has a subcomponent, you can see it here, which is for candy and chewing gum. Currently the inflation year on year is absolutely huge. So if you compare with Halloween last year, it's going to cost about 13% more to fill up your basket with your kids. But of course, it's not just about candy. If you look at a broad basket of goods and services, inflation's been surging everywhere. And it's interesting that some European countries have now overtaken the UK in terms of year-on-year inflation, such as Germany, for example. And whereas if we look in the US, the year-on-year contribution of energy, that's via gasoline, heating oil, that's actually starting to slow down a lot. And it won't be too long before it goes into reverse. And that'll pull down headline inflation in the US. However, in Europe, it's still going the other way. So if you look at Eurozone inflation, we've just had the latest numbers, and that rose to 10.7 in October. You can just see this steady upward rise. And if we break down that 10.7 headline number in October, you can see that energy is a huge contributor. It's up 42% year on year. But if we look at the broader basket, you can see that food, alcohol, and tobacco are also starting to surge upwards. And we saw the same thing in the US. Now, fortunately, we've had a very mild autumn in Europe, so that means many European countries could build up their energy stocks and fill up their natural gas reserves. However, we've just had an update from the UK Met Office, and this gives an outlook for this winter. And what they're expecting is that we're going to have a colder than usual winter. This is the distribution of temperatures. The dashed line is the normal likelihood of various temperatures. And you can see it's shifted slightly to the left, which suggests we might get more extreme cold temperatures. Another worrying thing is if you look at the windiness, that's actually going to be calmer than usual. So if we look at electricity generation, wind power, which now makes up a big component in UK energy, will contribute less. And that means we'll need more gas in order to generate electricity. The Met Office describes the drivers behind that, which is La Niña, which brings higher pressure regimes to the north and west of Europe during late autumn and early winter, and an ongoing negative Indian Ocean dipole, which apparently reinforces the influence of La Niña. But whatever the reason, it looks like it's going to be a tricky winter for people in the UK. And the reason for that is the UK has very little gas storage compared to the rest of Europe. It's estimated that we've got enough stored for about 9 days. If you compare us with Germany, Italy, France, the Netherlands, many different European countries, we simply have far less storage capacity. However, we have reopened a storage facility where gas can be stored underground, and that's increased our storage by about 50%. So instead of 9 days, I assume we'd have about 2 weeks of storage. But again, if we compare us with Europe, even including the new storage called RUF, we still would only store 2% of our annual gas demand, compared to 25% on average in Europe. So again, this is a strategically weak position that the UK finds itself in because of poor planning. And consequently, we could have a surge in energy prices for UK consumers this winter. Now, the energy price guarantee will help with that, but that only lasts until April next year. Beyond that, we don't know what's going to happen. How could that potentially help us as investors? Well, if you look at natural gas funds, these are funds which track the price of natural gas. Now, one thing you have to be careful of is which contract they're tracking, because we've seen a big divergence between European prices and US prices. And these are ultimately based on the futures market. But you can see that we've had this double surge in natural gas prices over the course of this year. And if you compare that with general energy funds, which you can see here with AIGE and BENE, natural gas has diverged quite markedly from a broad diversified energy fund. So if you think this is going to spike again due to increased demand from a cold winter, then you could buy one of these funds. The one which fell, by the way, was actually a one-time short fund, where you can benefit from falling prices rather than rising prices. There are also some leveraged funds, which I'd probably avoid at all costs. So I hope I didn't scare you too much, but I hope you can see that there are opportunities that come with each of these crises and scary stories. Remember not to be scared when these things happen. It always creates some kind of opportunity. Now, don't forget our offer. If you want to learn more about investing, you can do that as part of PensionCraft. Just click on the link beside me or look at the link in the description. And as always, thank you for listening.